Jeff Moe, welcome.
Thank you, Rob. Good to be back.
Yes, well, I'm glad you're back. And actually, before I get to you, I wanted to give a shout out to one of our listeners and thank them for this week's topic. Basically, a client who said, hey, we listen to your podcast all the time. We have a really clear understanding of what you look for when you buy companies, but we'd just love if you could devote a full episode to your sell discipline. And it was a great suggestion, hence, Jeff, that's why you're here. And I'm thinking, Jeff, maybe this episode could be over really quickly in the sense that we buy wealth-creating companies led by excellent management teams and purchase them at a discount to intrinsic value. Is the sell discipline that simple in the sense that it's just the very opposite of those three things?
I would say yes, it is. In the order that's most important for us as a buy discipline. I would say that the sell discipline tends to carry with it a little bit more psychological baggage as well, especially if you aren't in the green on that particular investment.
Well, let's dig into some of those sort of behavioral aspects that influence, it's different when you don't own a stock. I mean, it shouldn't be, but it's different when you don't own a stock versus when you've owned it and you've got sort of a track record with it. Can you dig into some of those sort of more common behavioral pitfalls that can get in the way of clear decision-making with respect to sell discipline?
Yeah, so what you just described is what Kahneman and Tversky calls endowment bias. So when you own something, my wife actually has great endowment bias. She even told me that she was very unsure about me the entire time we were dating. But once she said yes to my ring, she was all in. She's like, you are the man for me. So that's endowment bias. And of course, I hope my wife's not listening to this podcast. I don't want her to take the advice I'm about to give our listeners is try to always be considering your holdings. Don't get married to them. And I joke because this is, of course, not a marriage advice podcast. I hope you guys are not taking this as such. But the cure for endowment bias is to always tell yourself that you don't need to own this. It's not a full cure. I mean, the psychological bias is if you study behavioral psychology even briefly, you'll know that there is no ever cure. We are hardwired in our brains to have some of these biases. And there is an evolutionary benefit in many cases to have endowment bias. But I think the first step to trying to balance them out is to recognize that it's omnipresent. And so that's why we have tools. I think the matrix is one of the best tools to try to balance that endowment bias. Because if you have an inventory idea that has a better quality ranking and a better return potential ranking, you have to really start defending why you still own company XYZ that maybe is on the discussion for potential sell or exit.
Can you talk again in the realm of behavior, but just I think you mentioned earlier this idea that you might have losses or you might have gains associated with a holding when you're thinking about whether it's the right time to trim or exit. How does that kind of play into things and potentially complicate?
In addition to having tools, I think just having your process in mind at all times is very important. So when we buy, we very clearly try to go through and explain to ourselves and judge why the company is wealth creating, why it has a sustainable competitive advantage, why we think the management team is excellent, and on a probabilistic basis, why is it trading at a discount to intrinsic value? And so, and to go back to what you said, our sell discipline should not be more than the inverse of that. But oftentimes we can get in our own heads and it can become more than the inverse of that. And so that's why with the tool to tell us, the matrix, actually these companies over here might not be such a good opportunity anymore. Let's just walk it through the sell discipline. Is it potentially no longer trading at a discount to intrinsic value? The probability of it is very low. Has the management team slipped through either we've learned more about how they think, or they have proven through their actions that perhaps there is not alignment in word and deed, or perhaps their ability to execute is not as strong as we thought. And finally, and most importantly for us, is the competitive advantage still sustainable and strong? And so I would say that that is how we look at it, is that we would, as you go through those three, the faster you would want to sell is if the wealth creation, the most important part of our buy thesis, is impaired. And that's what we try to do every day, is just to take the emotion out of it, which is very, very difficult, and just go through logically and say, is this company still meeting that criteria?
Okay. Another thing that Mawer had talked about on this podcast not too long ago was just this idea. I think he'd read in a paper, somebody did a study and felt that institutional investors were often sort of better at buy decisions than sell decisions. One of the reasons this particular paper had posited was, well, maybe you just spend more time in your buy decisions, whereas your sell decisions happen kind of quickly. Is that your experience, Jeff? And do we have tools in addition to the matrix that help us slow down with that respect as well?
Yeah, I think I'm not sure what to call this in psychology, but maybe the shiny new toy syndrome. That's probably not a psychological term, but I think the prospect of buying something is exciting, something new, something that will help deliver a better risk-adjusted return for our clients than the current portfolio average. And so you want to put your brain power there. What's a lot less exciting is a company that's been a drag for 2, 3, 5 years compared to the portfolio average, a company that perhaps you have lost money on behalf of your clients for. It's harder to put mental energy into analyzing that with the same degree of energy. And so I think that's something you fight as well. That's why we have regular matrix meetings. That's why we do a delta report on every company in the portfolio, not only the ones that are going up faster than the market, or only the ones that are going up. And so I think these are mechanics in the process that force us to think deeply on companies that we may not immediately gravitate toward.
Jeff, the situations you described with respect to the inverse of the buy decision, I'm just wondering with respect to triggers. And so sometimes it can be the fundamental analysis that drives the sell decision, and I'm sure we'll talk about some examples in a bit. But sometimes it can be presumably just the price itself. And just this idea of, I know some investors have like stop loss procedures where, if the stock sort of drops by a certain amount, they won't ask questions. They'll eliminate kind of on the spot or have a policy around that. Now we don't, and or at least I don't think we do formally.
We don't. Correct.
Yeah. So why is that? Can you make the case on both sides? Like, what's the benefit of having that policy, and then why have we chosen not to?
Well, it's just because valuation is not the most important plank of our sell discipline. It's whether the wealth creation is impaired or whether we believe the management team is no longer as excellent. And in fact, with a stop loss specifically, if a stock price has dropped and everything else qualitatively about the company is the same, as well as the macroeconomic environment it operates in, then actually that company should be more attractive, objectively speaking. Of course, we never have full, complete information, and so you're always operating somewhat in a vacuum or in a fog of war. But a stop loss would be very anathema to our investment philosophy, because we are trying to judge whether a company has had its competitive advantage impaired, or maybe the management team is not as strong as we thought. Those things require qualitative analysis. And if a stock drops 21% and your stop loss was 20, and the machine automatically executed the trade to sell you out before you've even had a chance perhaps to analyze the situation. So maybe it's a situation where they've reported a very weak quarter and the trailing 12-month return on invested capital is now no longer greater than the weighted average cost of capital. I think you don't just sell out because of that blindly. You would analyze and say, well, could this have been a one-time issue? Could this have been something that is temporary? Or no, something permanently has shifted either in the company's ability to sustain its competitive advantage, or potentially something has shown us that our initial analysis of the competitive advantage was not as robust as we had thought.
Can you make this a little more tangible for us in the sense of, I'm just thinking of, and I'll start with the uncomfortable question. In your time at Mawer, I'm just wondering if you've noticed any sort of patterns of behavior with respect to your own decisions, or just times when we've kind of missed with respect to sell discipline. What's gone into that, and can you give us an example of how that's worked out?
Yeah, so it's funny. You would think that the sales are the worst, or the sell misses are the worst, are the ones that have gone down a lot, and maybe you mentally avoid them, and so you don't make a decision, and it goes down some more. And to be fair, in my career and in my observation of my colleagues here at Mawer, there is some of that. But I think the worst ones are actually the ones that go nowhere, and maybe that's a little bit counterintuitive, but well, I mean, going back 100 years, I mean, the equity markets have tended to compound around 9 or 10% per annum, right, on a nominal basis per year. And so we've had companies that we've owned both in the Canadian small cap strategy as well as the US mid cap strategy, the two I'm involved in, where companies have been flat or slightly down, basically flat for 3, 4, 5 years. And the worst part often is the return on equity or the return on invested capital is still in wealth creating territory, but maybe the company is poorly allocating that excess capital, or perhaps the dynamics of the environment in which the company operates in has shifted. Maybe growth is slowing, and so whatever, I guess, wealth is created is eroded by the fact that the market thinks that continuing value of that company is no longer as high because the growth has come down. I can think of in Canadian small cap, Winpack would be a great example. A company that did really, really well for over a decade. It had a pretty innovative management team in innovating plastic packaging for food and beverage primarily. And then plastics obviously became a little bit more out of favor. And then for whatever reason, their innovation took on a little bit less with the market. And they also had an issue with one particular customer that started diversifying away. Their largest customer, in fact, started diversifying away from Winpack a little bit. So a bunch of little things, but that's a stock that's largely been flat for 5, 6, 7 years. Arguably, could still be a mistake we're making today because we still own it. In the U.S. mid cap strategy, we had a company called SNC Technologies, and they are a pretty large player in providing software and outsourced services to companies like ourselves, asset managers, wealth managers, hedge funds, private equity funds, and so forth. And we thought it was a well-run company, a good market position, and I think all those things were true. But they started to make some acquisitions that were a little bit outside their core. It's still a little bit unclear whether or not those acquisitions have or will work out. But I think the market has taken a dimmer view to that new strategy. And in the interim, they've really struggled to find any source of organic growth in their markets, probably because active asset management is an industry that has suffered a little bit as passive continues to increase. So those would be two examples where we largely just held on for quite a while, believing in a thesis that was mostly correct, but maybe a little too optimistic. And so those are very interesting kind of mistakes that we've made.
Well, I think they're interesting for a couple of reasons. One, which you highlighted, just this notion that it wasn't so much the impairment of capital that came with this, just the lack of participation in the upmarket over a period of years. But the other one that seems common between the both of them is just that, hey, there wasn't some clear material thing that changed all at once. It was a combination of kind of small things. Like I would imagine that if some company made a huge acquisition so far outside of their circle of competence, that might be pretty easy to say, hey, this has shifted radically on the matrix.
Yeah. And I can give you a great example of one where we did sell because of that. If you want me to, I'm not sure if you were going in that direction, Rob.
how do you calibrate some of those little pieces of evidence that, by themselves, they're maybe not too much, but they start to add up. And at what point do you determine that significance?
Yeah, and I think that's something we are asking ourselves. So Samir and I'll give credit to Samir on this one. So Samir is my co-manager on the Canadian small cap strategy. In fact, he is now named the lead manager on that strategy. And he instituted this concept of a look back. And we've done this off and on, but he's really trying to make it a little bit more systematic for our team. And Winpack was one of the companies we talked about on that look back. And I think our learning was just being complacent in what the, the story or the deductive evidence that management was telling us, which had not changed through all this time because we might meet with management every year, at least during a Delta process, maybe sometimes more. And so we have notes saying every year they said, oh, yes, we still think we are a high single digit grower. We still think we're a very innovative market. We still think the market wants our innovation. Here are 5 or 6 new products that we are planning to launch. And it always sounds really good and really exciting. And the turn is just around the corner. And then it doesn't turn. And so I think weighing the inductive evidence a little bit more than the deductive evidence, perhaps, which is very difficult when it's a company that has um, done really, really well. And Winpack was in the portfolio before I joined Mawer, even as a summer student, which is 2006. So this is a company we've held for literally 2 decades. And so it's very difficult to change your mind on that.
Yeah,
We
there's that
actually
endowment
yeah,
bias.
that huge endowment bias, correct? But I think just one learning is um, don't don't just don't overweigh the deductive. Look at the inductive, and we have lots of tools for that as well. We have something called earnings monitor, where we marry together the standard financial metrics that you could find in any financial service provider with key performance indicators that we've custom chose that are impactful in our opinion for that particular company. And so when you marry those metrics together and you look at them over a time series, you start to get a better sense of inductively what is happening. So it's not just what's the revenue growth or the gross profit growth of Winpack, but how about the volumes? How about the volumes in different segments? How does that compare as the resin price index moves up and down? And so when you look at a wider set of data, you start to realize, okay, maybe things aren't going as well. And as much as I maybe I'm talking about Winpack right now, I actually think some of those indicators are pointing to uh, a slightly better setup for the company. CapEx is rising again, and it's one thing to talk about innovation, another thing to actually build factories for that innovation. So we're a little more positive there. But I would say MTY Food Group and Canadian Small Cap would be a great example of this is a company where we've made at least 10x, I think, for our clients from the very first day, for the very first share that we bought. And so it's very, very difficult for us to change our minds on that. So that endowment bias becomes higher. But it had, I think if you look maybe 2017 or so, the stock's been flat for 6 or 7 years. And largely because they started making larger acquisitions, the return on invested capital on those acquisitions was lower. And the company has always had more of a strategy to buy cheaper assets in the market. And why are they cheaper? Because they tend to not be as strong brands. They tend not to have strong competitive advantages in and of themselves. And therefore they have lower growth. And so now they've grown to a size where if you're paying a little bit more for those acquisitions and you have low growth, it's very difficult to create wealth with those acquisitions. And it took us several years to finally recognize that actually the capital allocation might be a little bit different at MTY. Not night and day change, but just a little bit different enough that the math no longer works in today's higher interest rate environment. And so that is a company that we chose to exit recently.
It actually begs another question which I had, which is, well, Jeff, we're long-term investors, and you've talked about a number of companies here that we've owned for many, many, many years. Does that get in the way in the sense that, hey, we're a long-term investor, we should hold on to things for long periods of time, but if something changes within like a year or two, did you ever find that that gets in the way of making the right decision?
Yes, absolutely. So Winmark is probably a really great example where I think so. So this is a company that we've held since the inception of the US mid cap strategy, but we recently exited. And so for us, that's still a relatively short holding period. But all the way through that exit, and it wasn't just a one and done. We must have made 7 or 8 trims all the way through. I kept telling myself, like, this is fundamentally a good company. We are long-term investors. I'm increasing capital gains for investors, and all of these thoughts that go through your mind. But fundamentally, when I look time again at the discounted cash flow model, and then quarter after quarter in our earnings monitor, as each new set of earnings came out, it just wasn't lining up. The probability that this company was trading at discount to intrinsic value just dropped lower and lower. Winmark is a great company. It probably was one of the highest margin companies in not only the strategy, but at all of Mawer.
And just for listeners, this is the used clothing and other used goods franchise.
The franchisor of used products retailers, clothing being the most common product that people buy used. And so they have steady growth. They tend to do better in recessions because people tend to trade from buying new to buying used. And so it has a lot of great characteristics. And plus the penetration of used clothing is still going higher. And is a bit of an on theme. I think there's a bit of a pushback against consumerism nowadays. So some of the younger generations, especially, while wanting to buy used, thrift, so forth. And so it's hard to sell a company that's on trend, that is defensive growth. But I think on just dumb multiples, it got to 40 times earnings at one point. And through a period post the pandemic, the company had also become, I guess, more focused. They had sold or kind of discontinued the second division that they had, which was a leasing business, had nothing to do with the core business. They had focused all the energy on the core business. They were starting to sign up more franchisees through this focus. And so things were starting to come through, and then you're starting to see it in the numbers. The growth at one point got into the low teens when you consider just a franchising division. So we said, okay, we can see why that would justify perhaps a higher multiple. But then the growth rate started pulling back, largely because I think retail, as well as just generally that COVID boom, has come off a bit. And yet the valuation was still quite high. And so I think this was one where eventually we exited our position. But I think, as I was saying earlier, the Jeff of 5 years ago may have found that difficult because of our investment philosophy. But I think that's just the learning and the maturation of investors and the psychology ultimately that comes into play with investing. I mean, this is a team game, but this is also an individual game, right? You still have to use a hockey analogy for our Canadian listeners, you have to individually shoot the puck or make your hit, do your back check, while still play in the system and get off the ice when you're tired and all the things that make hockey a team game.
Do you find that as a long-term investor, we tend to sell slowly? And by that I mean, you mentioned like several different tickets, trimming on the way down versus selling quickly all at once.
I would say for valuation reasons, that's probably fair. Not necessarily because we're long-term investors, but just because that's the weakest point, our sell discipline. Because if you look at our discounted cash flow models, often the fair value ranges can be quite wide because we are open to the fact that the world can and often does unfold in very, very different scenarios.
And especially if you have great management teams. Yeah.
Exactly. Yeah. And so Winmark, I mean, at one point, we thought it was only like a 5% chance. It was still undervalued. But I mean, there's still a chance it was undervalued based on our discounted cash flow work. But if you look at companies like Premier or Celebrite, Take-Two, these would be ones where our view on the business model and management or the risks had changed materially, and we got out relatively quickly.
So, Jeff, where have we done a good job with sell discipline? Like, where is it really just kind of gone exactly the way that it should?
Usually a good job means not losing more money as opposed to anything else in a sell discipline. But one that I can think of off the top of my head is Premier, which is a holding in our US mid-cap strategy, as well as our global small-cap strategy, and both got out. Premier is one of call them three companies in the healthcare group purchasing organization. They're a group purchasing organization. So essentially, they help a bunch of hospitals and clinics and other care organizations combine their purchasing power, which in the US, in the more fragmented healthcare system, is a big deal. And so the theory was that, well, they help the clients essentially bundle their purchases and then negotiate a better price with the providers of various healthcare consumables and devices. The thought we had in our mind was, with only three players in this industry, they should probably have pretty resilient pricing power and should be pretty inflation resistant. And when we invested, the valuation looked pretty good, assuming that even though we knew we were going to a slightly higher inflationary period, presuming that they could pass along the inflation. Well, after probably 1 or 2 years of being investors in this company, it became apparent to us that they were not passing on inflation as much as we had thought. And so that really made us question their competitive advantage. Maybe it's actually either the hospitals and their clients have more negotiating power against them than we thought, or perhaps their suppliers have more negotiating power against them than we thought. But either way, the competitive advantage we thought they had by being one of the big three didn't really matter. It wasn't really there. And so we exited already at a loss. And I think since then, the company unfortunately has done a little bit worse since. Another good one would be kind of when our assessment of management suddenly changes. So there was a company in our US midcap strategy as well called Take-Two Interactive. They are a video game maker, probably best known for Grand Theft Auto. And so we liked franchises like Grand Theft Auto, and they also own NBA 2K, the basketball video game, because these are very strong franchises, attract a lot of players, and every time they release a new version, you get a lot of new purchases. And it's a relatively steady Eddie business. And video gaming generally is still a growing industry, and so you get some growth as well. However, they made a very large acquisition that almost doubled the size of the company when they purchased Zynga, which is a mobile video game developer. And mobile games tend to be hyper casual. They tend to have very different monetization methodologies, but generally they just don't have that ardent fan base that will come back for more. It's not like, Grand Theft Auto has been around for 15 years or more. Like some of these games have, they're kind of, 2 or 3 years of strength, and then they start fading. And so it was very different. It really changed and weakened, in our opinion, the competitive advantage of the company on an overall basis. And more importantly, they paid a very high price going into a period where Apple had just changed some of their kind of privacy rules around tracking a user within the iPhone as they moved from app to app. And that would make it very difficult for a mobile game company to market. And this was sort of known, this was talked about. Everyone was saying that Zynga and others will have maybe the cost of customer acquisition have to go up, i.e. the profits have to go down going forward. Yet they paid a very full price for it anyways. We took a little bit of time just to kind of assess it and make sure that our thesis was correct. Unfortunately,
are we missing something? Yeah.
Are we missing something? Exactly. And so we didn't exit, the second day after the announcement, although maybe we should have in hindsight, looking at how the stock played out. And then what ended up happening is the stock price and the market was so upset, the stock price dropped to a point where the Zynga asset was no longer worth anything according to the market. And the base business was now worth 20 or 30% less because the stock had dropped a full 50% on basically this acquisition from what we can surmise. And so we said, okay, the valuation is too cheap at this point, but we really reevaluated management on a matrix to a much lower score. And when the valuation recovered about halfway, which is roughly what the value we thought that perhaps management destroyed through this acquisition, we exited that we thought was a fair value, but now with a much lower matrix score quality. And that's another example where we were quite comfortable with that decision, even though I think since then it's kind of been a bit of a wash from a stock price perspective.
Jeff, you've spent your career in the small and mid cap space. And so whether it's, different parts of the market cap spectrum, or maybe different geographies, different industries, does the sell discipline adjust based on those factors, at the margin?
It shouldn't. If it does, it's because of psychological biases, not because of any plan. It should adjust. The sell discipline shouldn't adjust. The sale should adjust based on where we think the competitive advantage is trending, where our judgment on management is trending, and what probability of discount we think the current share price represents.
Well, just maybe to push you a little further, I'm thinking maybe in the small cap space, like you might just own more of that business. You might own 10, 12% of the actual company. Might take you a lot longer to get out of something. Are you more sensitive to negative news and to kind of move quickly, knowing that it might take you some time to exit the position completely?
Well, I think that's actually where the buy discipline comes in. So if you buy wealth creating companies, even if it's like Winpack or MTY, where maybe the wealth creation starts eroding a little bit, it's not like the company's suddenly not worth anything. You're racing to the exit with everyone else who's also realized this.
I feel like we're getting closer to the marriage analogy again here.
It's still a well-run, asset. And so, like MTY, like we probably managed to sell that probably over 2, 3, 4 years of trims, and not in the market all the time, but just over time we got a little bit less confident in the thesis and started to reduce our position. So no, I would not say that because we sometimes in smaller cap companies own more of the shares, it makes us more flighty or more jumpy. If that's what perhaps you're implying with how you worded that question.
Okay, but it's great in the sense that I think your answer just connected so well back to, yeah, it's the buy discipline that's important in the first place to reduce the chance of flightness in the end.
I think it was Buffett who said that our in this case Berkshire Hathaway's preferred holding period is forever, and the key in on it is preferred because not everything in life goes the way you prefer it to go. And so the self discipline really is talking about situations when you're out of your preference.
Jeff, are there any other aspects of the way that we go about investing that you think are important that we haven't talked about so far when it comes to sell discipline?
The concept of behavioral psychology is very important. It's not, I would say it's not quite in our process in the same way that, we have a discounted cash flow model or so on. But as I talk to more and more of my fellow portfolio managers here at Mawer, I realize we all have some form of a checklist. And if you read the book, The Checklist Manifesto, or even if you haven't, but basically a checklist is, well, one is a great way for you to be systematic with your thinking process. But two is a great way for you to slow down. And sometimes you are thinking of selling a company because there's been a huge move in the stock price. Some new news came out that's making you question your thesis. And so emotions can come into play, right? And we know in kind of the neuroscience of the brain that when emotions are high, higher level or high order thinking in the brain gets suppressed, and we become more like cavemen. We get amygdala hijacked, I think is the term I learned. And so something like a checklist is really helpful for you to just kind of go through and think through what, does this make sense? So is this company according to your current analyses as well as your teammates? Is it actually that much worse than the market average, the portfolio average? And so that's where your matrix comes in. You can reread the delta report. You can reopen the model, play around with assumptions and inputs. Like, is it truly trading at almost no discount to intrinsic value, perhaps? Just remind yourself of these psychological biases. So, I mean, in this case, it could be some type of, fear response that's causing you to want to exit very quickly. It could be another reason. Or vice versa, you don't want to exit because it's going to make you look bad, or all of these psychological things. And so, so a checklist is one tool. Another tool that I'd say it's only kind of starting to be used more systematically at Mawer is this concept of, I don't know exactly what to call it yet.
So just things that you look for along the way, I'm guessing.
Yes, exactly. And specifically, if you can come up with them prior to those things actually happening. Sometimes it could be a price target, but often it's a qualitative factor, such as, if the next big contract that's currently in an RFP, if this company doesn't win it, that would be quite surprising given how strong we think the competitive advantage is. That would be a time to check in on or recheck in on that competitive advantage. If you notice that margins are decreasing rather than increasing, or has decreased past a certain level, you would say that's surprising given the competitive advantage or given the management comments on the execution trajectory that they were expecting. So it could be a lot of those things. Often an acquisition that looks completely different than what you were expecting management to do could be a very common signpost to check in on. So I would say those are things that are another way to force that discussion in your mind of, okay, are you sure you want to be holding this? Because that was something you said 6 months ago that if happened, you are likely not very confident in your thesis anymore.
Yeah, and write it down, journal it, so you can't go back and do some revisionist history. Well, Jeff, thanks for joining us. Thanks for slowing us down to talk about sell discipline. Thanks so much to our client for the suggestion, and for all the rest of you, if you have suggestions for things that you'd like us to cover on future episodes, definitely let us know. You can email us at podcast@mawer.com. So Jeff, thanks again.
Likewise, you as well. Thanks for having me.